Hi, Danielle.
Hi.
Danielle Bronner is going to be our presenter today for Financial Planning One. And we're going to do a little different kind of a presentation than we've done in the past. In the past, we've kept our Danielle's outline on the screen for an extended period of time. And we've gotten feedback from individuals to say, we'd like to see the faces. So we're going to try to have more of a conversation today. And one of the first things that we do is that we go through and find out a little bit about Danielle through the Ask First form. The printed Ask First form is online just below her outline. So I'm going to ask her some questions. And Danielle, what kind of educational background do you have?
Sure. So I have a bachelor degree in economics and then a master's in business from University of Chicago. And then I'm also CFP as well. So lots of credentials.
Yes. And how long have you been doing financial planning?
Um, at this point, about 14 years. So
14
yeah,
years.
yep.
And give us a little background as to whom you've worked for and who do you work for today?
Sure. So I'm actually from Chicago originally. So I started in, kind of your traditional finance path at large firms, such as Morgan Stanley. I was in their ultra high net worth group. And that was on the broker dealer side, which I know we'll talk to about, the difference between fiduciaries and non. So started there. And then I was actually at another firm called Green Street, which we worked with individuals and family offices who had a lot of real estate. So really helping that portfolio and diversifying. And now I'm a partner with Ocean Heights Advisors. We're a registered investment advisor. I focus specifically on planning, though my background is also investment management as
Yeah.
well.
So we've asked Danielle to speak today just on financial planning one. Danielle could give the entire 6-week course, but then you would only be introduced to her. We like to introduce you to many different fee-only fiduciary financial advisors because a lot of it has to do with rapport. And we're going to get into that in just a little bit. But as far as licenses are concerned, do you hold any licenses?
Well, the CFP and then the Series 66. So that's just it's a
65, I believe it's.
I actually have the 66, which
I'm
is a combination of two. But yeah, because when I was at Morgan Stanley, I did everything. So,
Yeah.
uh-huh.
So in your who gives us this license?
FINRA.
FINRA. And
Yep.
what is FINRA?
It is essentially the governing organization for our industry. So there's SEC and then there's FINRA. And so this is a very regulated, I guess, industry. So it's really important that, who you're dealing with are licensed to be able to provide you investment advice. And then the CFP, that's a separate
That's a
uh,
credential.
credential. And that
That's
is, not everyone has it in our industry, but that's one more level of planning.
well, I
And
like to
yeah,
consider the understanding the difference between a credential and a license.
right.
Credential for the CFP program, it wasn't just taking one exam.
No.
You had to take 6, 7 different courses.
Mhm.
You had to be 3 years in the business. You have to actually be a financial planner under
Mhm.
a mentor. You're held to a fiduciary standard. Uh,
Correct.
I believe that's. I need you to nod your head.
Yeah, no, you're absolutely right. I
Yeah.
mean, it's
So the series,
it,
the FINRA
FINRA is separate. Yeah.
is a self-regulatory organization.
Hmm.
So Merrill Lynch, Morgan Stanley, they regulate themselves, and everything that about FINRA is full disclosure. So my door is knocking. I can't answer it. Anyway, um, um, this there's all sorts of different series exams that you can take. Does the series exam that you have allow you to sell insurance or financial products?
No, it does
Yeah.
not.
And that's the difference. Series 7, I believe, allows you to sell products.
Yes.
So from an audience point of view, from somebody who's not familiar with the industry, they should be looking at a 65 or a 66. If somebody has a Series 7 through FINRA,
Right.
then they could sell stuff.
Exactly.
Yeah.
Yep. They can take commissions, sell insurance, sell products, all of the above. Yep.
Yeah. So that's why it's important to understand what kind of license the individual has. Do you have do you people look you up on FINRA, and how do they do that?
Yes, so you can look us up through, I think it's Broker
Broker
Check.
check? Yes.
Yes, and that you can really look up any firm or any, an investment advisor on Broker Check. You can see the full history, and what's most important is making sure that they have no disclosures. So we're very, clean. Every firm also has an ADV, so you can look up that just to look at the full firm's
Do you have
background.
the do you have your ADV form on your website?
We have it in our signatures. I don't know if it's on our website, but it's in our
Okay.
signatures. Yeah.
Yeah. Make
Mhm.
sure that when you meet with a fee-only fiduciary financial advisor, that you read the
Mhm.
ADV form. You don't practice law, but in the practice of financial planning, you go through their estate plan. Is that
Yes,
correct?
that is correct. Yeah,
Yeah.
our firm is very comprehensive in what we do. So we'll focus on both portfolio management, but also looking at all aspects of your financial life, which includes your estate plan, your tax plan, your charitable donation strategy, your,
We're going to get
insurance,
into some of that.
all of that. Yeah. I
Yeah.
mean, we'll take a look at all of it. We don't draft or, we're not lawyers, but
Yes.
we're a free resource so that, we've worked with a lot of clients over the last 20 years. So we know, how laws have changed and what certain clients are looking for. So we'll kind of be that first conversation, and then they'll use what we've shared and actually work with an attorney to implement.
How are you compensated, Danielle? What do
We
you
are,
charge your clients?
yeah, we're fee only. So it's a percentage of assets. So it's very clean, and we don't have any hidden fees or anything like
What
that.
is that percentage?
It can range, I would say around 1% is
1%?
average. Yeah.
Do you have a minimum?
Yes, our minimum is 1 million liquid.
Okay.
Yeah.
And do you give any kind of free consultations?
Yes. So we will actually give a full complimentary consultation, as well as a full review of your analysis of the portfolio and even putting together a preliminary plan. So we do a lot of sweat equity work up front, but I think that's also a good indication of the work we'll put into the relationship as well.
Yeah. The beauty of that is that it's very educational
It
for the
is.
individual
Mhm.
who has not ever worked with a
Right.
fee-only fiduciary advisor. You have worked what I consider to be the dark side,
Mhm.
Morgan
I
Stanley,
have.
on the broker side. Talk a little bit about the difference between now as a fee only versus on. By the way, I'm not trying to say that Morgan Stanley people are bad people.
Yeah, I mean,
There's
I
just a
worked at
different.
both, and I consider
Yeah.
myself an ethical person. So,
Yeah. Yeah, there's a
yeah,
different culture though. What is
very
that
different
differences?
culture. Yeah, so it depends on where you're at, but Morgan Stanley, Goldman, UBS, all those firms are very massive firms, and they each have small teams. So every team is a bit different. It's kind of like the Wild West, but the consistency is you will have pressure from the banks to sell their products, to sell their funds, to, make loans, take commissions. Like, they're not being a broker, you have three kind of stakeholders that you need to adhere to. It's, yourself, the client, and the firm. So you can technically sell something to a client that has a higher fee or commission to the firm. As a fee-only fiduciary, we can only do what's in the best interest of the client. So we legally cannot sell, a product with commission. So I would say working at Morgan Stanley, I was on a great team, but there are certain pressures from the firm to sell certain things, and that may not be suitable necessarily for everyone.
Yeah. Uh, and who do you custody the funds with in your firm?
So we work with Schwab and Fidelity.
And either one.
Either one, they're the largest. I mean, they're,
And
very
then
large.
why is that important to a client?
Very important, because if anyone's heard of Bernie Madoff, you never want to write a check to
Isn't it
Ocean Heights
ironic
Advisor.
that his last name is Madoff?
Exactly. Yeah, I never thought about that, but you never want to write a check to the advisor or the company that you're working with. It always needs to be, independent at a Schwab or Fidelity or custodial bank, because they're the ones that will hold the assets, but legally everything's still in your name. So, even though we're advising and trading, we can never go and say, let's distribute $200,000, right? That's nothing. We don't have access like that. And that's really important to make sure that anyone you're talking to, never write a check to them.
No, make sure it's an independent custodian. The other thing I think the Bernie Madoff story is relevant is that be aware of affinity groups. Bernie was a very Jewish, very connected to some of the regulators. And so he used that affinity to gain the trust of someone, and people who were highly intelligent, very aware, didn't pursue a simple thing like a broker check or who do you custody your money with? And because trust is so important. So if you have somebody who approaches you and at your church, make sure you still do the ask first form. If you have somebody that meets you at the Rotary Club, make sure you ask them to complete the ask first form. If you have an advisor at the present time and you have not given them the ask first form and you don't know all the things that are on there, please give it to them. Danielle, are you affiliated with anyone who sells annuities, insurance? Do you accept or give referral fees?
We don't accept or give referral fees. We are affiliated with a much larger company called Mariner, and they do our compliance and back office. Through them, they also have an insurance group, a full tax group, large alternatives investment groups. So yes, we technically can advise on insurance, but as a company, we cannot take commissions or any referral fees. So think of them as like a completely separate company, but we have easy access to them. So that only helps to provide more resources for the client.
Okay, if a client is with Schwab or does Schwab charge additional fees to the client?
No.
Okay, and so it's all inclusive in the 1%?
Yes, yes.
And same thing for the firm called Mariner?
Yeah, they're a service provider, so there's no fees. We just pay them a, percentage of revenue, but we're 100% employee owned. So that's a really nice benefit. We're not employees of, a big company.
Okay.
Mhm.
I'm still confused by that, but we'll go, that'd be another conversation. Danielle, let's get into the program.
Okay.
You want to pull up your website, not your website, the outline, and
Sure.
then we'll kind of go back and forth and talk about it.
Sure. So, we went through my background here. Our
By the
company.
way, you have just an excellent background for for doing comprehensive financial
Oh,
planning.
thank you. I appreciate that. Yeah, well, and we're a good firm too. I mean, we've been in business for about 20 years. The history was started by a husband and wife, very entrepreneurial background. So we work with a lot of entrepreneurs actually is, kind of one of our specialties. And we really started as a true investment management firm. We have a fantastic track record for, prudent growth. I mean, we're not looking to invest in like Rivian or Teslas. We're much more like Warren Buffett style investing, but really fantastic track record there. And as many of our clients grew their wealth and there's more complexity with real estate, with charitable gifting, with just overall planning, we really now do more of a holistic kind of planning approach. So we work with about 150 clients, very high touch, very personalized. There's 7 full-time people. So really wonderful family, friends type of environment. And that's kind of how we're not looking to get, massive, right? Like we really want to make sure we preserve that friends and family feel for our clients.
Let's go to the next slide.
Yep. So today I'll be talking about, really 9 strategies to put into practice. I don't know if we'll get to all 9 of them. We'll keep this very conversational, but it's really important to, as you're thinking about planning, really to have a framework. Really this is just a high level kind of overview, and we can always go a little bit, deeper.
Yeah.
So the first tactic is, or strategy is really thinking about your story. What has been your financial story, right? If you think about and reflect on your personal family, your history, how
Why
have
don't you go
you,
ahead and come on screen
sure. Oh,
and we'll
okay.
continue talking about the slide.
Okay. Yeah. So, really think about, how have you approached your finances, right? Are you a spender? Are you a saver? Have
Can
you
you
been
turn
able
a
to?
spender into a saver or a
You
saver into
can. It's hard, but
that? So it's not
it
impossible.
happens. I work with clients to reel them in a little bit.
Yeah.
Have you been open with your spouse and family to help them steward their wealth and, be educated, right? And have you worked with someone in our industry, a professional to guide you, right? So your mindset really affects your financial success, and really getting clear about your history and your story really helps to uncover a lot of, kind of your personal values and your attitudes, and really figuring out kind of how you achieve your goals. So just understanding your biases is really important.
It's almost like your first date,
Yes.
when you get married. You really need to have that rapport
Hmm.
with the client, and the client needs to trust you and hear your story,
Right.
so that you're almost a counselor, a coach, because where do we learn about money?
Exactly. Right.
It's very hard. We're going to go into goals in just a little bit. But where do you find most people have, uh, if they have money, what have they done in the past? Why do all of a sudden come to you, for example?
Good question. We work with all sorts of different people. So I would say, whether they came into it because their family, they inherited the wealth, or they're divorcing, or they built a business and are now ready to exit, right? There's a lot of different reasons people come to me. Or I have a woman, she's early 40s. They make, almost $1 million a year between her and her husband, but they've never saved, right?
Yeah.
They've never really planned for college. They have, a couple million in net worth, but it's that time where their kids, now they're growing up, they need to start thinking about how to optimize their cash flows. And so there's a lot of different reasons. Or I have another client who just sold their business, and now, they're looking to figure out what they want their money to do for them after, 50 years of working in an industry. So it's very personal, but I would say that, it is a very important conversation to have,
Yeah.
because then you understand what motivates them, what their value system is, and then that way you can tailor the approach to meeting their
How,
goals.
how important is to know their goals? And is
Very important.
everybody clear on their goals?
No,
Yeah,
it's very difficult to, I mean, some people are, but I would say the majority,
yeah.
um, they might have goals like they would like to leave, a legacy of X, right, for their kids or for charity. But, short-term goals are really hard for people to kind of isolate and really organize. So what we'll do is look at everything they have, build out a preliminary plan and share opportunities and gaps. And through that conversation, then people say, uncover, oh, yeah, that is something that I'd like to focus on. Right. And so we
On,
help
uh,
guide them.
yeah, on your outline, you have that great picture. You want to pull it up for a second?
Oh,
The
on the next slide.
yeah, where it says hand with the
Oh, yeah.
I love that because it really kind of it financial, attitude, artistic, educational, pleasure, you know, you really are a counselor
Yes.
when you go through some of this stuff. And the next slide, you want to bring that up? Uh the let's see. I thought you were let's see. I thought there was some more goals. But people
Um,
can't but in when somebody gives you a goal, do you have to know when they want to achieve it and the dollar amount?
Yes, I think, there's different types of goals, right? There's goals like, I'd like to retire with, X amount of money. And, then we look at kind of your time horizon and, how your investments are working for you to get there and are there ways to optimize things. There's also in general goals like, helping with, kids education or traveling, right? And they may or may not have a dollar amount with them, but what's important is understanding the time horizon for those goals, because once we understand the time horizon, we can then look at the specific portfolio, your cash flow strategy, your trust and estate, and make sure that those are all aligned to accomplish the sequencing of your goals, right? Because
Yeah.
if you have a goal that's, 40 years from now, that's a much different exercise than if you're remodeling a house or, looking to buy your first home in a year, right? So the way you accomplish them, it depends on, the plan and the time horizon.
Yeah.
So that's why here I actually, your portfolio and investments, making sure you understand, the taxes, cash flows, risk tolerance, time horizon, but also your cash flow management, because all of that works together and and then you can think about other goals, maybe being more charitably inclined, or, it could be, figuring out your trust and estate, right? So there's a lot of different qualitative goals too that we work with clients
One
on.
of the things that we talked about last week, when we did the overview, we talked a lot about the tax status. So I'm sure individuals come into you with already a portfolio. And what do you need to know about that portfolio
Well,
from a tax point of view?
yeah, we'll ask for statements because that way we can understand how things are titled, meaning are they retirement accounts? Are they trust accounts? Are they individual accounts? There are different laws governing retirement accounts versus non-retirement accounts. So from a tax perspective, it's really important to understand that,
Yeah, but I'm
because
not talking about, for example, cost
oh
basis.
yeah, and then right. So in non-retirement accounts, if we are working together and thinking through optimizing the portfolio, we need to look and understand what your cost basis is. Meaning, if you bought a stock for $100 and now it's $200, you have a built-in gain of about $100. And if it's in a non-retirement account, it's taxed at a different rate than if it is in a retirement account. So we need to make sure we understand what your tax budget is as well. So some clients have losses that they've garnered from previous years. So we'll kind of build around that. If you have made, I have a client that's been invested in Nvidia since 2005. You can
Wow.
imagine. Yes.
Yes.
So, she has thousands and thousands of percentage of growth.
Gain. I mean, she's
Yeah, yeah. I mean, so, and it's, it's up almost, 60% just this year, but
yeah.
we will not sell out of that position for a number of reasons. One being the taxes, but two, it's a great company. And we'll build and complement around that to make sure that she has a diversified portfolio.
Well, that gives me a charitable opportunity. You gave me an
Right.
opening, Danielle. You know, um, uh, and I had a number of questions, but when somebody has such a large capital gain, to turn that into income or diversification, we're not going to talk a lot about this, but a charitable remainder trust
Mhm.
is just an awesome opportunity to sell that asset tax free, to sell it and get an income tax deduction, and to turn that into income.
Right.
It's an area to explore for anyone who has a large capital gain. But that
Mhm.
also leads me to ask you, in your practice, are you as a firm active managers, or are you more index passive managers? And explain what the difference is, and what would you do with a client's portfolio if they have very low basis in their investments?
Good question. We are on the spectrum more active, meaning we invest in individual stocks for the most part, and we'll construct essentially a customized fund of stocks for our clients. Um, we can use ETFs as well, which, some clients prefer, but for the most part, we're more active. But we're not day traders. I mean, we're probably making one or two trades a quarter. So we're still long-term investors, but
And
with a
what does
more
long
active.
term mean? What does a long term mean?
We buy and hold stocks that we feel will, for at least 18 months to 2 years. We feel at that point we can look at them and monitor, but we're investing for at least the next 18 months to 2 years.
Yeah, there's other firms out there, and not just fee only, that once you bring in a portfolio to the professional, they'll sell out the entire
Yeah,
portfolio
we don't do that.
instantaneously.
Mhm.
And boy, can you imagine somebody doing that to somebody who owns that stock?
I
That would be
know.
horrible.
Yeah, it would be.
But
And we've actually had clients that came to us because their former advisor sold them and reallocated everything. It's in a retirement account, there's no tax considerations.
exactly.
But if you have significant gains in a taxable account, then yeah, that's why we will look at everything very detailed and build around it. So if you do have risks or concentrations in certain industries, we will then complement with other investments. And then from an income perspective, if we have clients who have Apple or Nvidia or Berkshire with significant gains, it's tricky. I mean, we'll either do a charitable remainder trust strategy, or we might write call options. So for Apple, well, we have a couple clients. We don't usually do options trading, but for generating some income, we might do a little bit of that. But if you really have highly appreciated stock and nothing really, then it might not be the best fit. Just there's not as much you can do with that.
Yeah. People try to put things in a category of good and bad investments, and investments are neutral. And just like reverse mortgages are probably bad for 90% of folks who have them, but then there's 10% that the reverse mortgage is absolutely excellent for.
Right.
So, it's like options. More likely, most people who do options trading are not going to come out ahead.
Right.
But then again, sometimes that strategy works for an
Right.
individual. The other thing is, how important is cash flow?
In what way? What do you
And
mean?
cash flow for an individual as far as budgeting and spending and
Oh, very
I mean,
important.
are you
Yeah.
gonna for your clients, do you hammer them with a budget? Is that
No, I mean, I think we're
what does
fairly,
that mean?
yeah, we're fairly you know, relaxed in terms of working with our clients. But
But
if they are spending, so in general, if you're using the portfolio as a salary, like you're no longer working and it's an income tool for you, then we will essentially build the income through dividends and interest so that you're immunized and protected. So even in a March of 2020, when the market's down, you still are getting your monthly paycheck, right? So that's how we structure things when you're really living off the portfolio. If you're spending more than 5% of the portfolio, you are at risk of dipping into principal, because that, it's just a rule of thumb. You expect about 7% long-term returns. You're taking 5, you leave a couple for inflation. For my younger clients, or those that aren't living off the portfolio and they're just looking to add additional savings for certain goals, then we'll go through a detailed analysis. And I have a, I can pull it up here,
Super.
but I
Yeah,
have, yeah.
go ahead and pull it up, and then you know, so
So
really,
we'll,
you really have to understand in the beginning, right up front, how
right.
much is a person spending on an annual basis?
Exactly. And we'll map this out over time. This is kind of a larger client, obviously, but they're working until, and this is from last year, but until 2026. So you can see the different components of their cash flows. So all the inflows, you have salary and bonus, and then other income, and then a little bit of Social Security as well from the husband. And then the red is the expenses. And so really, if you see between retirement and when you start having to take distributions from the IRA, this is where you're taking from the portfolio. So these are withdrawals from the portfolio. So we really need to optimize and make sure we're immunizing the portfolio, bridging the gap in this. So usually what we'll do is we'll look at pre-retirement and then post-retirement. And at retirement, we might shift and reallocate into more of an income-based portfolio so
You're
that,
using a technical term called asset allocation.
yes, yes.
You want to define that? What does that mean?
So asset allocation, I mean, it's a very broad term, but in a portfolio, there's different ways to invest. You can use stocks, you can use bonds, you can use alternative investments, and the mix of those investments is the asset allocation. Within stocks, you can have large companies like, Amazon or Microsoft. You can have smaller companies. You can have international companies. So there's a lot of different sleeves. But interestingly, 70% of your return is driven by your asset allocation. So how much you have in stocks versus bonds drives most of the return, not so much the individual holdings you have, which is an interesting fact.
Yeah, it is very interesting. And we want to make sure that we're diverse,
Yes.
in that asset allocation. I I think most individuals that wouldn't know how diversified their portfolio is until they have someone like yourself actually review their portfolio.
Yes, correct.
Because there's 20,000 plus different mutual funds. There's
Right.
more mutual funds out there than there are stocks on a stock exchange.
Right. And people, may look and see, 5 different mutual funds, but when you look at the constituent holdings, you might own Microsoft 5 different times. So even though you think you're diversified, overall your portfolio's, 15% Microsoft, right? So there's a lot of duplication. So you do need, so our firm will actually look through the holdings details and put together an analysis so you understand. And not only looking at your portfolio, but if you have 401ks, if you have real estate, putting a comprehensive asset allocation that includes all of the different assets you own, which is really interesting. So even if you have $1 million portfolio of stocks, but you have 3 million in real estate, right now your stock portfolio is only 25% of your net worth, which is an interesting fact that a lot of people don't think about, kind of putting it all together in the big picture.
Yeah. Yeah. But how much do you spend on an annual basis, and future spending literally drives the portfolio,
Yes. Most
and
people will ask, well, how much do I need to to retire?
yeah,
And it really depends on your lifestyle, how you
yeah,
envision living in retirement, and also your asset allocation. I have clients that are retired and, have rental income that's supplementing all their expenses. So their portfolio is really not, it's really for the next generation. So they can be more aggressive, even though they're, 75, 80. And if you read a book, then you would say, oh, they should only be, 50% stocks, but they can afford to be much higher because they're not living off the portfolio. So that's also, it's not just about your age, but it's about exactly your cash flows.
And another thing too is that I think at some time in your life you could spend principal.
Yes. Yeah.
There is no 11th commandment. Thou shalt not spend principal.
That's
And
true.
you can't take the money with you. And so how old do you have your clients live?
I have them live till 90, but I have a
Really?
couple
Yeah,
clients that
only 90?
well, yeah, and I call it sunsetting, but they want me projecting till 105, believe it or not.
Yeah, I think you should, you put all of these numbers, what they spend on an annual basis, their tax issues, and can you then do what ifs?
Yes. So I actually put together a page, and this is a little bit small, but once we have, just like a business, once you have your balance sheet, your assets, liabilities, your cash flow, your income statement all mapped out, and you have a baseline for a plan, then you can really think about what if scenarios. And a couple of these include, how much based on the lifestyle will we, have for our heirs or for us, right? And so in this case, they have a significant surplus. And so we'll tell them they can have more fun in life, or think about gifting early. At one point there was a discussion on capital gains rates going up to 35%. So, that was something we could do. Or if you're gifting to charity or your family, can you afford to do that? And then very importantly, your trust and estate plan. So we'll even go through and say, upon your death, what does that look like? And upon your spouse's death, how do the flows look and what your taxes may be? And that's really important, especially now before 2026, because the state exemption might actually, very likely go down. So that will affect more people. So a lot of people are focusing on, on their trust and estate right now.
Yeah, yeah. As you get older, then you want to make sure you don't run out of money. And
Right. You don't outlive your assets. Yeah.
yeah,
And something too, we have clients that ask, can I afford to spend another 20,000 in travel? And for clients who are, in retirement, one of my clients actually, he kind of used it. I don't know if he coined it, but he calls it the go-go years, the slow-go years, and the no-go years. I don't know if you've heard
I,
about this.
I'm in the slow go
Okay,
nears.
yeah. So, after retiring, you have, the go-go, so you might spend more.
Yeah,
And you have the slow go where, you're, normalizing. And then you have the no-go, but with the no-go, you have the healthcare that comes
yeah.
in. So it's kind of a U curve a little bit, but so we'll truncate your years and your plan according to that.
Yeah. For the entrepreneur, the person who's starting their own business and they have to pay into Medicare, they have to pay into Social Security. Do you work with those kinds of clients and try to minimize the impact of those kinds of taxes?
Um, we have clients that are self-employed that are paying into, obviously paying into those. We actually have a tax team that will help to look into things in more detail. We don't usually go that granular,
Uh,
but we do have a full tax department that will do an analysis and
yeah.
and advise on that.
An entrepreneur asked a question, and
Oh,
one
okay.
of the nice things about being an entrepreneur and working for yourself is that you can create your own retirement plan.
Yes.
And we're not going to get into detail on that, but that's available to the entrepreneur where you
Yeah.
can actually control your income on an annual basis.
Right, you can minimize by creating your own, whether it's a SEP IRA or I-401k, or, there's a lot of different options.
Yeah.
So,
Yeah.
mhm.
So, when you have a new client, and is it hard for people to start talking about how they spend their money and how much they spend annually? Because I know, especially husbands and wives, number one reason for divorce is money.
Uh, yes and no. I think that a lot of people who don't have a good grasp of what they spend, that's when we can really be helpful. And we have a full financial planning questionnaire that we'll go through with the client, and that will help to identify the areas that they need to focus more on. We have worksheets for cash flow planning. Um, I would say that, usually with a husband and wife, there are differences in how they approach spending. So that's usually interesting.
Yes.
And, at the end of the day, we aren't there to say it's right or wrong, but we are there to show the trade-offs of your decisions. So if a husband really wants to spend, X amount of money, or thinks, that their investment is, I have a client, they're two entrepreneurs, both of them,
Uh-huh.
and they both started a company. One thinks that this private investment is going to be $10 million in valuation. The wife thinks it'll be zero. So modeling out their net worth,
The wife
right?
is
And
probably correct.
right, and the two of them in the meeting are just kind of like on different sides of the table. So it's very interesting to navigate, but our job is to take the conservative approach, show them, okay, in a draconian scenario, if it really went to zero and you have all these other assets, and your income streams,
It's
what
the
does that
what
look
if.
like?
It's the what if.
It's the what if, and
Yeah.
we can
Yeah.
show the rosy case, but usually we're there to keep people accountable.
Yeah.
So
Yeah.
it's really important to have a solid baseline and then build from there. But yeah, we have clients of all different.
But it's the marriage, it's the relationship,
It
it's
is,
the
yeah,
trust, it's the opening up and talking about what your real feelings are. And there's no wrong feelings,
right,
This is how you feel. So
exactly,
talk about it.
yeah,
One of the things that people need to do, besides just if they're doing it on their own, is just to make an inventory of all of
right,
their assets. And on slide 3, you kind of go through the building a balance sheet.
yes.
And businesses do this all the time, but do you find that individuals somehow don't?
Yes. Yeah. Very smart people, and very sophisticated, don't understand their net worth. So, and don't even know where to look. So
Yeah.
that's why we'll start with a questionnaire that'll help to identify what they should look for. And then I had a client, they're in their 80s, very philanthropic in Newport Beach, and they had no idea what they were worth. They knew that they had a commercial real estate asset, they have their house, they have a couple IRA trust accounts, but we uncovered they had $2 million in life insurance assets. They had another a charitable donation, DAF, that they had created that they even forgot about. Jewelry, I mean, they had a lot of different assets that they didn't remember. They had money in their safety deposit box that they forgot about. So I'll go to their home and go through it, and even kind of just look at old tax returns and just understand, what everything is, so that God forbid if something happens, not only for your own benefit, but for your family's benefit, what there is. And with that, making sure that you have a trust in place, you have durable power of attorney documents, you have your advanced healthcare and financial directives. So all of those documents need to be in order. And so that's all part of this kind of inventory,
Why don't you pull
process.
up slide number 3, or point number 3?
Yeah.
I think you have it all right on there. The know your current financial picture and net worth, I think, is the number 3 I have on the screen. There you
Oh,
go.
here, yeah.
Yeah, and then we'll go to, in fact, let's go through the next 3 slides while you're talking.
Sure. So, as Pete had mentioned, taking inventory is really, really important. And that starts by building a balance sheet and your income statement, just like a business, right? So looking at, different sources and assets, cash, investment accounts, retirement accounts, your real estate, and then your income that can be, salary, pension, social security, rental income, and then all your different expenses. We'll usually bucket expenses into fixed and then discretionary. So, these are just couple different line items. And then there's one time, which is important because those should be separate. If you're doing a home remodel or adding a pool or, have a wedding or something that you're paying for, right? These are kind of the one-time expenses. And then with that, it's important to have all of your different financial documents and goals in place. So your trust and estate, your tax return and strategy, your insurance policies, if you have them, any inheritance that you're expecting. So all of this together really, is informative and helps to guide decision making. So it makes, it's very important to kind of take the time and figure out where you stand and what your net worth is.
Yeah.
And
Let's go
then
to, yeah,
this is just an example.
yeah,
So
but
we have a
so
financial planning.
important,
Yeah,
so
we have a
important.
we have a financial planning software that we use for our clients. This is just an example where, we'll look at all these different accounts, your liquid net worth versus which is your, investment accounts or cash accounts. And then we'll look at real estate and then your debt to give you a total net worth. And then on the other side, your bonus and your salary as well. So this was, just a sample.
Yeah, if you're doing it on your own and just get the help of a CPA and or even a bookkeeper. But you need this information. When I was at Long Beach State University, 80% of the professionals had no clue of their net worth. How can
Mhm.
you invest if you don't know the net worth?
Right.
How do you know the risk tolerances? Uh, uh, People's biggest fear is running out of money and or reducing their lifestyle. Uh,
Mhm.
you have to crunch the numbers. And you, in your firm, you say you look at the numbers at least once a quarter for your clients?
Yes, we will review the plan. Generally, we'll review it twice a year, or if there's a meaningful life event that's occurring. It doesn't change as often.
Dramatically on a quarterly
Yeah,
basis.
but we will review the portfolio on a quarterly basis. So
Yeah.
the plan, it all is a marriage, right? If you have a good plan, but you don't execute it well, that's not great. Or if you have, a portfolio, but it doesn't fit with the plan, that's also not great. So when we're setting up a relationship and starting from the beginning, we'll put it all together and then life brings change. So this is always evolving and breathing. This is kind of
Well, that's what the beauty of
right,
the long-term relationship, because
right,
when you do the plan the first year, then the second year, the third year, you
right. You're
start to
just
see
updating.
patterns and
Right. Mhm.
how are you spending your money? We humans hate change. And so we're kind of consistent in our behavior. So that's why I was asking about a spender and a saver. I find it very difficult to turn a
Yeah.
spender into a saver.
Yes.
One of the other things I love about fee only advisors is that the help that you can bring to the entire family, because you can help out the younger individuals. I know my kid doesn't listen to me, but he may listen to you, Danielle.
That's true. We are multi-generational as a team and also with our clients for a
Yes.
reason. And we really focus on making sure that the next generation understands, is educated, and can steward the wealth. And we'll even, for clients that are, 12, 13, 14, if they want to learn about the stock market and investing, we'll, the parents might set up a small account for them and we'll spend an hour and going through, stocks, and they'll pick a couple companies they like. So just getting them interested, I think, is really important. So
Do you,
we definitely
do
do
you,
that.
do you pay attention to try to put the portfolio into a capital gains scenario versus ordinary income?
What do you mean?
In other words, so that it produces capital gain income versus
Oh,
ordinary?
yes, yeah. I mean, most of the time capital gains is lower than ordinary, so we will prioritize that over ordinary. And even doing like a Roth conversion might be something worth considering for clients to basically convert it into no gains.
Yeah.
So
Yeah.
tax free. So,
Yeah.
there's a lot of different ways to kind of
How
orient.
about how about asset location? In
That's
other words,
very important.
you mentioned Roth, a regular IRA outside of retirement plan. What should somebody kind of look for generally when you're trying to figure out where to put the bonds, if they have an annuity, where to put the annuity, etc.
Sure. So really good question. Generally speaking, for anything that is interest bearing, so this is bonds, annuities, depending on the type of annuity, we would encourage you to put it into a retirement account because you're deferring the taxes.
Well,
Versus,
we probably wouldn't want to put an annuity in a retirement account
well,
because
it would, yeah, or
yeah,
qualified annuity.
yeah,
Yeah.
exactly.
Yeah. Yeah.
So
So you wouldn't want to put the annuity, but it's better to have an
an
um,
income generating
income generating. Yeah, yeah,
into your retirement
in the
accounts.
retirement. Yeah, and then the stocks, more the growth assets that are maybe dividend oriented or don't have a dividend, you can put those into non-retirement accounts because you're paying much lower taxes. And the benefit is if there's no dividend, then even if the stock grows, unless you take it out or sell it, you don't pay any tax on it. So, for the most part, mutual funds are separate discussion, but
Yeah.
yeah, so it's better to put anything that has interest and ordinary income into an IRA. And then for Roths, because you don't pay taxes, you can put, you know, really anything in it that you want, but usually for clients, we'll put more of the growth investments there
Yeah.
because it's long term.
When you do your free review or no obligation consult with a brand new individual, it how do they need to bring in their tax return and their statements in order for you to kind of give a helpful feedback?
Yes. Ideally, the more information that we have, the more beneficial and informative our discussion is. We don't require it, but if you give us the information, we can really look and put together very detailed analysis. So, and there's no obligation to work with us. So by doing that, you come away learning something, and hopefully you either confirm you're on track, or it opens your eyes to maybe needing to work with someone. So
Or, the other thing too about the free consult I think is really important is that there's usually in a marital situation, one party handles the finances
right.
and the other party is totally clueless. In my relationship, I was totally clueless, and my wife, the CPA, handled all the money. And so, uh, one in most marriages, that seems to be a scenario when one of the partner dies or is left. I think the partner that didn't have the financial wherewithal or wasn't interested in it or whatever, please see a fee only financial advisor,
Yes.
because they're there in your best interest, and being alone and not having anybody to bounce ideas from is really hard because there's a lot of predators out there. We should call it "It's your money and everybody wants it."
It's true.
Yeah.
Yeah, we
So,
have a number of clients that we do a really, really good job in making sure both parties are involved, even though one may be the decision maker, at least the other one is educated and aware, because we don't want our clients being deer in the headlights where someone passes away and they don't know where to go. So that's
well,
why it's really important that we're working together as a family.
Yeah.
and putting together an inventory, right? Because that outlines everything that is in the estate, which is really, really important.
Yeah. By the way, scammers is, yes, they're out there, but most of the time, problems arrive in court because of family issues. So, talk to your fee only advisor before you make gifts to children or fund a major business enterprise that one of your kids want to start, or uh, talk it through. And because everybody wants to do what's best and follow your goals, but if you do it in the right way, it usually gives you a better result.
Yeah, we have clients. I have a situation right now where, the daughter was gifted everything outright, and she's 26, and unfortunately, her friends are taking advantage of her, and she's a very giving soul. So she's just, offering to help. But we, as her accountability partner, are saying, look, if you're spending this, you will run out of money by the time you're 33. So she, hopefully is understanding that. Whereas we have other clients, we would always advise to put it into a trust, and put milestones into a trust, because if you aren't aware of, the repercussions or situations where it doesn't necessarily turn out to be in the best interest for the family, it's really important to understand kind of what the different options are and the different ways to achieve them. So we'll usually recommend kind of going through a number, just, outright versus gifting via trust, versus, maybe setting aside some money, not in the kid's name, but in your name. So there's different ways to do it, but it's really important to talk to someone before you go ahead and just set up accounts.
Yeah. A couple of points I wanted to talk about with you and get for you to talk about it a little bit. In some of the first meetings that you have with your clients, you got to figure out risk tolerance. And what does that mean? And how do you go about that?
Very good question. So risk tolerance is, wide spectrum for most people. It's really not only your willingness to take risk, but your ability to also take risk. So some people may say, oh, I really love, high growth stocks like Tesla or Rivian. I see the future of, EV and autonomous vehicles. But if you're living off the portfolio and this is your source of income, then you aren't able to necessarily take that level of risk. So it's actually, a combination of both. And usually it's not, some clients, they'll say, well, my advisors asked me, am I aggressive? Am I moderate? We don't bucket people in our company like that, because every situation is different. What we'll usually understand is your cash flow needs, your overall kind of asset allocation, potential additional inheritance or whatever, so we get an understanding of what your scope is, what the total amount is. And then we'll look at, short-term goals versus long-term goals, and prioritize using the tax status of the account, using, the capital gains that are in the account. So there's a lot of different levers. But risk tolerance, I would say, we have some clients that, can be a lot more risky, but they're very conservative. They
Yeah.
don't want to take the risk.
Yeah,
So
so there's a
there's a
whole
whole spectrum. Yeah,
mentality
right.
to this besides the hard numbers.
Exactly.
Because you don't want to take any more or greater risk than what you are spending on an annual
Exactly.
basis for the rest of your life.
Right.
So you got to try to find that sweet spot. And then there's the psychology of it all.
Right.
The Rivian, the Teslas,
Right.
or
Right.
cryptocurrency, or I got the most, I mean, I have invested in companies that I've heard at cocktail parties, and the worst kind of
Right.
investment you could possibly make.
Yep. your friend's, book that he's writing or
Yeah,
something,
exactly. So you have to understand the risk tolerance for every individual client, and probably husband and wife have
Right.
different risk tolerances.
Yeah. Right. And for those types of clients, sometimes we'll have the wife's IRA invested differently than the husband's IRA because they're, different individuals. So
Yeah.
it's all based on psychology, and it's an art and a science at the end of the day.
Yes, yeah. But again, it's not on the brokerage form. When you fill out an application, it asks you, are you aggressive? Are you moderate? Are you talk a little bit about suitability liability versus best interest liability,
Um,
fiduciary versus suitability.
yes. So as a fiduciary, we can only do what's in the client's best interest. So we have to understand exactly what your objectives are, your risk tolerances, and make sure that we are designing a portfolio that, makes sense. You understand what's going on, you're comfortable with it. We're constantly, communication with you on it versus suitability. It's a looser regulation. So technically, if the client, signed off but doesn't really fully understand it, you're not going to be adhering to the same strictness. So, or if the company that you're working for is pushing a product and it could be suitable, but not necessarily, 100%, it's a grayer definition.
Well, it's what I'm
Yeah.
getting at is that on the application, please don't
Mhm.
put down that you're aggressive, very sophisticated advisor, because that means that they can push product on you
Right.
that is very quote unquote very risky, high commissioned, and in the realm of suitability.
Right.
Uh, it's kind of like being an accredited investor. Uh, that means that we don't have to disclose a lot of stuff to you because you have a sufficient net worth, so you must know what you're doing.
Right.
You know,
Mhm.
completely false, by the way. That if a business or you're an entrepreneur in your business, you're very smart at that business. You
Right.
might not just be smart in the consumer finance area.
Right. Yeah.
So you have a slide called tax loss harvesting, and you mentioned the individual that had the highly appreciated stock.
Right.
So, what would you do in October, November? What does this tax loss harvesting mean?
Right. So if you're selling your real estate property and you have, call it, $500,000 in capital gains, then in the benefit to having individual stocks or ETFs is you can tax loss harvest. So if, in a year like 2022, when the market was down, you can actually essentially sell the positions at a loss and then garner, call it $100,000 in losses that then can get offset the capital gains. So it's a way to net out your capital gains. And then after 31 days, you can repurchase the companies. In the interim, usually what we'll do is in October, November, we'll ask all of our clients, do you have capital gains that you need to offset? And if there are ways to tax loss harvest, then we will sell at a loss by maybe the sector. So if we're selling, a couple technology companies or consumer companies, we'll buy the sector. So you still have exposure, but you're not buying it, and then we'll repurchase that stock at the beginning of the following year. So this is a way to basically lower your tax burden for the year. Some clients will also just do this knowing that you can carry forward those losses. So some clients just ask us if there's possibilities just to take the losses and have that as like a extra tax budget, moving forward.
Yeah, but in order to do this, you have to know what you're invested in.
Right.
So, list your assets. I think it would be very helpful if you put how you hold title to those assets.
Right.
And then use cost basis. What does cost basis mean?
What you bought the stock for, essentially
Yeah.
what the amount you purchased it for, the price per share.
Yeah. And then you need to understand the market value. So, so you have it in front of you and you know October, November, kind of what has the capital gain, what has a loss. And that's where, the fee only advisor is looking at that on a quarterly basis.
Yeah.
But
And
if you
we,
do,
as a company, we're active, but for example, if we have a client who has a significant gain, like if we're trimming a little bit of Amazon, I'm just making, and we have clients that have significant gains, we will not sell because they'll incur gains. So we try to stay as tax neutral as possible. Obviously, years when the market goes up, it's harder to do. But in general, we really are mindful of taxes. And I think it's very important. We have clients that had come from other advisors that had, $60,000 in gains. And then their CPA, tells them what their taxable liability is. And they're surprised that they owe, $10,000, $15,000 in taxes because the advisor was not paying attention. So we are very good about that. And that's also why we don't work with a lot of clients, because otherwise it's hard to do that.
yeah, we like to call our workshop It's Your Money the unchange. Do not make any changes in your portfolio until you figure out, one, what changes are you going to make? Two, what is it going to cost in both taxes and fees and anything else as to make those changes? Most changes are not done free. And then three is that what is it going to cost you going forward in the relationship?
Right.
So, don't make changes quickly. The tax loss harvesting, we should all be doing sometime or October, November, etc. Let's see. Number 9 on your slide. Let's go through some of these. By the way, we have an entire session on investments. So I don't want to, investments is the apple rolling off the card, I think. And Danielle, what is your overall philosophy on investing per se? Because most people who come to this program think investing is what all we're going to be talking about, and we haven't really talked about any of it.
Right. It's one piece of the puzzle. It's not the entire puzzle.
Yeah, that's a good way of explaining it. So let's go through some of the additional tips.
Sure. So, the first and foremost, most important is identifying goals.
How
And
many goals should a person have? I forgot
we
to
ask
ask.
usually for clients to put 3, 1 or 2 short-term and then 1 long-term goal.
And so what kind of, give me some goals that you commonly see for your clients.
Retiring, I think having a solid plan for retirement, whether that's, having a certain amount in your bank account or a certain age that they're targeting for retirement. I think college planning is really also fairly, common. And then on the flip side, legacy planning. So for the next generation or charitable organizations.
Do people have a goal like I want to spend X amount annually until I die?
We
I want to
haven't
know
really
that.
come across that as often. I would say it's don't run out of money.
Yeah.
And then we run the numbers and we tell them how much they can spend.
I've got an objective in my mind that I'm going to leave my son $500,000 to $1 million, but I want to spend the rest.
Right. Well, there's actually in the system a liquidation strategy. So it's how much fun can you have in life to get you down to
fun or give to charity. Or I want to feel comfortable doing it.
Right.
And I certainly don't want to run out, but that would be one of my goals, personal goals.
Oh, good.
But I mean, so do you help people spend money?
Yes, we do. Some
Yeah.
clients, you won't believe it. I have a client who, she's 34. She inherited, well, she has about, 3 million, and she spends about 4,000 a month. And she has no husband, no kids. She's young, but I don't know if she even wants, so, I mean, if you project out till 90, she breaks the system. I mean, it shows her being like,
Yeah.
billionaire at that point. So,
Yeah.
those conversations are, you can spend a little bit more,
Yeah, and it's hard to have conversations about money with other people. I mean, I
Right,
just had my family over this last weekend, and it was difficult for us to talk about money, even in our being brothers and sisters.
right. Yeah, and
Yeah,
it's difficult. I mean, my family's from the Soviet Union and Chicago. It's a very different lifestyle than it is here in Newport Beach. And,
yeah,
my family's in town, they're looking at real estate housing and the
yeah,
prices, you just can't anchor,
yeah,
and so even though, I come from a very conservative kind of, entrepreneurial, they came with nothing, right?
yeah,
Like, but being in the industry that I am, it's just such an interesting dichotomy
yeah,
sometimes. And you
yeah.
have to be graceful. And I think,
I think it's a lot.
everyone, even if you have more, but if you spend more, that's also not a good,
Exactly. So you
situation.
got to have
So,
that sweet medium. Time
right.
to organize your data. Talk about that just for a little bit.
Right. So I would encourage all of you to, whether you have someone you're working with or would like to schedule time to speak with me, we do have a questionnaire that guides you through this exercise. So this is really the balance sheet, the income statement, all the important aspects, that you should be looking for in building. And then the next piece here is asset location. That's tax status, and then income planning. So looking at your current income plan versus what you'd envision your life to be moving forward. This is more just kind of investment philosophy. Do not try to time the market.
That, by the
Or
way,
does
that's $1 billion industry.
it? Yeah,
CNBC
it
is
is.
all
Yeah,
about trying to, tell you what's hot, what's not. Be careful. You can't,
yes.
nobody knows what's going to happen tomorrow.
Right. Yeah. So we, like I said, we're much more focused on quality companies that are profitable, have strong cash flows, that will weather the storm. Taxes we talked about,
Yep.
and then maximizing your contributions. So this is a tax planning strategy. So going back to the entrepreneur or just people that are, W-2 earners, really make sure you're maximizing as not just to get the match, but the full amount if possible, because that will reduce your taxable income for the year. Spend less than you earn. I
By
think
the
that's
way, the spend less than you earn is kind of like if you're under 70, you may be spending more than you earn, but a lot of times there's such a difference between the different generations.
right. Yeah. So
Uh,
that's
the trust, review your beneficiaries. Please review them. We go through that in detail. The other thing too that you could do in a trust, because I think it's really difficult to raise kids if you have a lot of money, because it's hard to say no. Um, uh, but you can
incentivize.
your kids or your beneficiaries by saying, hey, whatever you earn, I will contribute double from the trust.
Right.
You can make an incentive.
Or we have a client who in the trust, it's mandated that the beneficiary gets a degree in finance.
Ah,
So, and then they're eligible, right? So there's different ways to do it.
yeah. And then I love number 9.
Yes, keeping yourself accountable, and then, life is not a set it and forget it plan, right? It brings change. So review
Yes.
everything periodically and adjust.
Yeah. Awesome. Hey, put up your contact information. I think is the next slide.
Oh, how do I here?
There you go.
So this is my email.
Yeah. There's your emails, the cell office.
Yeah.
And so If you have a personal question or would like a free consult, please touch base with her. Danielle, come back on the screen. We've got about 4 or 5 minutes. If anybody has a question out there that they have, please let us know. Where are you located, Danielle?
We're in Fashion Island, so right across Pimco and the Pendry. The new hotel it was the Island Hotel, not the Pendry. It's beautiful.
Yeah, it's a great location.
Yeah.
How many staff people do you have working at your office?
We have 7 full-time people and then interns and then our back office. There's probably over 100 people that work to help us.
Approximately how much do you have under management?
About 650 million.
Okay. And you mentioned that the staff to client ratio, what do you think is how many clients can you possibly manage with the present staff before you have to hire anyone new?
I would say we're probably around 40. Well, we work as a team, so I
Yeah.
would say we have about 50 that we share, but probably about, 30 to 40 that are, kind of more independently,
Uh-huh.
kind of work with.
Morgan Stanley, what was the ratio?
Um, it can be up to like 800, per advisor. So,
800 clients per,
my team,
and
it
that's
was
the ultra
different.
high net.
Yeah, we only had 50 clients and we had about 1 billion in assets. So it was a very different clientele. But
Yeah.
I would say a retail advisor like at Morgan Stanley or Schwab or Fidel, they can have up to 800 clients. I mean, they're not providing the same level of service. So we work with about 150 clients as a firm.
Yeah.
So
So remember, it's a marriage. Remember that I think you should at least interview at least 3 fee-only advisors
yes.
and be honest with them. If you don't like their hairstyle, just let them know. Because you're gonna want a long-term relationship with them, and the only way to start off that is by being honest. And they need to know your portfolio. Do you ever have a client saying, okay, I'm gonna give you a little bit, I want to see how you do, and then the rest of it, I'm not going to tell you?
They usually will tell us, but they may start with 1 million and we'll earn our keep and then they'll add. Yes.
Yeah. But you need to kind of know their
We do,
entire.
because if we're in a vacuum and they're selling something and we're buying something, that's not beneficial for them. So we'll need to know the full picture and then we can always manage a portion of it.
Hey, Danielle, did a great job.
Thank you.
I wish we
Thank
were had
you.
a.
You as well. I always enjoy working and presenting with you. So
Yeah, well, too bad we didn't have an audience and then we could hear the applause. Next week we're going to do, I don't know what we're going to do, but our schedule is on our website. And please take a look at it and hopefully we'll see you soon.